G'day expats, ladies and gentlemen. Welcome to another episode. As always, I have my co-pilot, my co-host with me today, Jeremy Harper. Good morning, mate. How are you?
Morning, James. Very well, thank you. It is Thursday, the 5th of February. So what does that mean for listeners out there?
We have had an RBA decision this week, and what a
Yes.
cracker. And the minutes were obviously very interesting, and that's what we're going to unpack a little bit today, as well as
Yep.
some of that employment data. But not only that, there's been whispers of the Labor government looking to make some changes to the 50% CGT discount concession, or I guess the way that you calculate your taxable capital gains when you sell a property. So we're going to unpack that a little bit today. But yes, let's first kick off with what the decision was from the RBA.
Yes. Yes. Well, we record in January. We said that there's not a lot of data in some of our January episodes, but there certainly is this week. So the RBA had their first meeting for the year on the Tuesday this week, and they have increased the cash rate by 25 points. So we're now seeing a official cash rate of 3.85%,
Hmm.
which is the first increase in 2.5 years. Yeah, last time was
Yeah.
November 23.
That's right. Yeah. So obviously driven by the inflation data, it's just too hot.
Hmm.
It's running too hot at the moment. It was above I think it was 3.6 to 3.8, depending on what measure you look at, whether you're looking at core or the trim mean or headline CPI over that 12-month period. That was from the quarterly readout as well. So December, just remember the quarterly readout is always a lot more in depth compared to the monthly readouts that we see in the news. And it just appeared that there's things in there, especially services and products, which are just too sticky. So it
Yes.
forced their hand, and it was obviously running above their expectations. So they're left with one decision to increase it by 0.25.
Yes. And the decision was unanimous with the board. So I always think that gives us a bit of insight into what they might be thinking next time round or the next meeting. But
Yep.
that means to kind of flip their votes, there's going to be a fair bit of different data for the next meeting. And I guess on that question for you, historically we see when there is a rate rise? Do we normally see it once off, or do we see a bit of a trend in the short term?
Oh, it's very rare that you see just one.
Yeah.
So I would say, I mean, if we look at probably what the RBA rate tracker is doing and what it's
Yep.
forecasting for the end of December 2026, it's saying that we will finish at about 4.25%. So that's obviously not always accurate, but it just means that we should see at least two more rate increases in the current year. So, and usually when you go back and you look at trends, it's never just 1.25. That really doesn't do much to the economy, to be honest. Yeah, it doesn't do much. So I would say that we are still going to see at least one to maybe two more, maybe one to three more if inflation remains sticky. But yes, the trend is that we'll see a few more now.
Yep. And noting the next meeting's the 17th of March, so not
Yep.
too long away. So, we're sort of five weeks away. So I wonder if there's anything that's really going to change their mind. Remember, all unanimous, or how
Mm.
they're going to vote the next meeting. So if you're talking about that rate track, it is early days, but there's a little bit of a trend showing there that there is potentially the market's pricing as of yesterday a 13% chance at this stage of an increase at the March meeting.
Yep. Yep.
So we'll keep an eye on that in the coming
Yeah.
weeks.
And if we look at probably the main talking points that came out of the RBA in the minutes, demand was stronger than expected, especially for the December quarter. So private demand ran a lot hotter than they had forecasted in the I guess, the last 6 months of 2025. Labour markets still very tight, so unemployment that stayed quite low for the RBA, which we'll just touch on very shortly. Inflation stayed sticky. Yep. And I guess financial conditions not restrictive enough. So that just means that plenty of people are still demanding goods, services. Supply's not there to obviously meet that. So when that happens, it means the cost of everything goes up. That's the inflation factor. And now, obviously, we are faced with that 0.25 increase, and we'll probably get another two, to be honest, over the coming, I would say, 6 months.
Yeah. And for those that are out there with a existing variable mortgage, that means that within sort of the next week to the next 10 days, the bank, I'm seeing most of them have passed on the full amount.
Yep. Yep, I
We'll,
know
we'll,
CBA.
the
I know
CBA were
CBA
very
did.
quick to make that announcement. They weren't, they had the finger on the button.
They
Actually,
did.
ME Bank, shout out to the marketing communications team that they sent out to all brokers and customers. They
Ooh,
actually said, we are pleased to announce that we're increasing the rates by 25 points. So a bit of a cut copy job from the last cuts. So
yeah.
whoever's their marketing manager may have a bit of a talking to. So I don't know how pleased their customers were to receive that email.
I know. It's yeah, I think CBA's rates go up, I think, on the 14th of Feb, but mainly broad-based, it's pretty unusual if a bank is holding that 0.25 and not adding it on, because again, it's just a direct cushion to their bottom line in terms of profit.
Yep.
Obviously increases their revenue. It's just remarkable that the RBA can control banks' revenue like that. It's just unusual, so unusual, but it's so common. But at the moment, I think when we look at probably the next couple of months, there's just going to be some fine tuning. The RBA might not make any more decisions until they get another quarterly readout. So that
Hmm.
wouldn't be until, say, April, the start of May from March, just because that carries a lot more in-depth data. In the meantime, we'll still get those monthly readouts, but the RBA might not use those to actually make a decision on the rate increase. They might just be patient. So might not mean we get the full 0.25 to zero point 0.5 until after the September quarter throughout the year.
Yeah, yeah. And I think just they did make a big note about the strength of the labour market.
Yes, yeah.
And I think something to point out was a lot of that is driven by government. So from August 22 to August 24, there's 658,000 jobs created.
Mm,
Of that, about 82% was from the public sector. So the
mm.
government does have the keys to take some of that heat out of the employment market around
Yep,
I guess, the demand side. They're not
yep.
doing that. So let's see, I guess, how they'll respond to this readout themselves.
Absolutely. I think the current government needs to take some ownership over it. I think we saw that budget blew out now by 50 billion from a
Yep.
surplus. And you see a lot of the a lot of the taglines in the news right now. Gymflation,
Yep.
Jim Chalmers, Gymflation, which is a good one. So a lot of people are pointing the finger at him that they've just been spending too much, and that's caused the demand side, and off we go. But again, they did talk about the private sector, so whether that's the government engaging private firms. Yeah, I think inflation will probably run it hot this year, to be honest. 3.6 to 3.8. I think the RBA was saying that the trim mean should go up to 3.7.
Hmm.
And that's where they're saying it'll peak. I think looking at how quick it's risen, especially in the last 6 months, I'd say it wouldn't be surprised if inflation got over 4% this year and then it started to track back down towards the end of the year. So that's
Yep.
probably what I'd expect. But we can have inflation going up and the Australian economy is still tracking well. Just because inflation is going up doesn't mean we're going to head into like a hard or a fast economic recession or anything like that. That's not always the case. Right now, it's just going to show that the economy is running quite well, but they need to obviously stamp down spending to get inflation under control.
Yep. Yep. Definitely agree. I think, and some of those revised inflation forecasts from the RBA, I think, are quite optimistic. I don't think it's going to come down as quickly as they forecasted, and they've actually noted here that they've recast their forecast upwards to reflect that.
Yep. Yeah, exactly. So we'll see what happens in the coming months, but probably a good time to move on to our next topic about the 50% CGT discount concession.
Yep.
That's been in the media more recently. Seems like there's some whispers going on within the Labor government about their upcoming budget in May.
Yep.
Now, the 50% CGT discount concession has been on the chopping block with Labor a few times now,
Hmm.
2016, 2019, which actually made them lose, obviously, the votes that time round. But we've got to remember that Labor has this juicy majority now, and
Hmm.
they're obviously in power for the next couple of years, and probably another term after that if the coalition can't get their shit together.
Yep.
With that in mind, it means that we could start to see these punitive tax policies. The one that they've proposed is reducing, or they haven't proposed it yet. It's mainly someone from inside the party has announced that it's likely probably going to be released in the budget, but they want to reduce the 50% CGT discount, likely down to 25%, because that's what they previously proposed. So it might be worth us unpacking what the discount concession is first.
Yep. So I think first just talk about why, they talk about it was introduced by Costello back in 99, but really it was prior to that, you had the ability when you were lodging your tax returns and you were trying to calculate the gain on an investment to index the cost base to reflect, the true value of the cost base in today's dollars. Now, as you could imagine, it's way too complex to calculate. People get it wrong. So then they just landed on this number. So, I mean, I think to kind of paint it as just something that, well, the Liberals did that. It's a bit of a free handout. I think there's a bit more nuance behind that, and it seemed to have worked. So I think just kind of painting that as these evil investors that are taking advantage of this tax break, if they call it that. It's actually that ruling was replacing what was in place in a different calculation, and now it's a lot more straightforward to calculate. But in its current form, and of course the way Labor work is they'll sort of leak these things out through the media, get people talking about it, get a bit of a feel for it. They did that with the superannuation changes around the unrealised gains.
Yep.
Get everyone talking, get a bit of a feel for the temperature check to see where the conversation is, and then they may come back and try and adjust that before they try and make this, or try and attempt to make this actual legislated policy. So that's sort of the backstory. I think from what I can read from this article, firstly, the big red flag for me is why are we getting, quotes and input from the unions?
The unions?
It has nothing to do with the unions. I want to be hearing from the CEO of CA Australia, CPA Australia, the accountants. I want to hear from the accountants. I don't want to hear from the unions. This is completely irrelevant to them. So that, I think for me, that just gives a bit of insight into what's driving this policy change.
Yeah. There's been unions have provided commentary, like some have announced like you should still be eligible for the 50% discount after the first 12 months, but then every year it winds back by 5%, 5 percentage points for every year you hold it. So, and then going back to what Labor wanted to do, where they had it at 50%, then 25%. How it operates right now, if you're just a normal Australian tax resident, so not an expat, an Australian tax resident, if you bought an investment property and you own it for more than 12 months, that's the key sort of caveat and criteria, and then you sell it, you only have to pay tax on half the capital gain, so 50%. So a quick example, Jeremy and I buy a property worth $1 million, or let's say I buy a property worth $1 million. I sell it in 5 years' time worth $1.5 million. That $500,000 of capital gain, I get to discount by 50%. So only $250,000 goes into my tax return, and I'm paying my marginal tax rates on that 250K. So it just gets added to my income. Now, if they remove that, it means I would effectively be paying tax. If they dropped it down to, say, 25%, the discount, then that $500,000 gain gets discounted by 25%. So my taxable gain is $325,000. And that just gets added on top of my other income, and then I pay marginal tax rates on it. So what's probably likely going to be the cause and effect if they do change it, or if they reduce the discount concession, and they only apply it to property, because that's the other thing. They're trying to look at this to see if it'll fix housing affordability, the housing crisis. I don't know how it would. Investors still won't flee the market, to be honest. But they're thinking about changing the discount concession of how it's applied to property. So what you might see is that people get a bit more creative with their strategies. So they might start using, say, companies to invest in property, which is going to give, obviously, brokers a bit of grief in terms of lending policies and those sort of things. But the reason why someone might use a company in Australia is because its fixed tax rate is 30%, but it doesn't get access to any of the CGT discount concessions at all. But at least you're paying 30%. And just remember that our marginal tax rates, including the Medicare levy, go up to 47%. So that's why people might start using companies instead. I could still see property being a really good tool as part of like a broader, obviously, wealth strategy. People might get a little bit more creative and, get 2 to 3 properties as a starting base in terms of investments over, a time frame of 10 to 15 years. And then rather than buying another property, they might then pull equity out and then go into shares, because shares might still be entitled to that 50% CGT discount concession, and then just do a debt recycling strategy using shares for the remaining 10 years of their working life. So there's, yeah, it's definitely going to be interesting if this rolls through. But last time they did this, they obviously got thrown out. So we'll have to wait and see whether this rolls out. One important factor around this concession: Australian expats, non-residents for tax purposes, they actually don't get access to this concession. So they removed that concession as of the 8th of May 2012. So from the 9th of May, you couldn't access it anymore. That's going back to 2012. So right now, if you're buying an investment property as an Australian expat, great, you don't actually get access to the concession. You only get a pro-ratering. So if you own that property for a period where you're a non-resident and then also an Australian tax resident, then you're just applying the concession to that period that you've owned it as an Australian tax resident, and that's also pro-ratering the concession. So it's going to be interesting. It doesn't impact, I would say, non-residents much, but I wonder how they'll apply it to future sales. Is there going to be grandfathering? How are they going to unpack that? Different dates, those sort of things. It's a little bit scary, but it'll certainly change, I think, a lot of Australians' aspirations to accumulate a large property portfolio and invest in property. It'll definitely change the goalposts there. People need to pivot and see what's more tax efficient.
Yeah, yeah. And I think it will just add in additional costs, as you were saying earlier. Depending on the state, if you own a property in a trust or a company, there's different land tax thresholds, rates. So that means more revenue for the state level. I'd imagine that all the states would get behind this. They'd be pretty happy with this change.
Yeah.
I guess, where does it start and where does it end? Do they start to, I've got a feeling they want to try and look at self-managed super fund borrowings and somehow try and prohibit that, because all of a sudden buying a property in a self-managed super fund perhaps looks a bit more favourable under these changes. And then, where does it go in terms of the main resident exemption? How would it impact the strategy around rent vesting, if that's something that people look at doing? If people are looking for a growth play, then are they looking at more, what does that do to, say, the apartment market versus the market where you're doing it more on the growth basis and the yield's a lot lower? So yeah, there's a lot to kind of go through. And I think what people kind of gloss over sometimes, they do look at this and they think, this government's very much trying to always pit people against each other. And in this conversation, it's about people have property, people don't have property. And if you've got property, you're evil. And if you don't, we'll save you. That's kind of their take. And all I would say is, with the high marginal tax rates that you said, if this goes through and people are working and they're living in a city and they're already near that high marginal tax rate, and then they have a sale on a property under these proposed changes, you're right. They could be paying, upwards of 50% on that, on the sale, which is frightening. Yeah, it's really frightening. And that's why you look, as you said, a company where it's got the flat rate, you can kind of control your tax outcome slightly. So
yeah. And on that example I gave you before about if they change the discount from 50% to 25%, and let's say my taxable capital gain was 325,000. Well, currently, if you're on an income in Australia up to 200,000, your average tax rate is pretty much 30%. So anything over 200,000, your average tax rate starts to climb above 30%. So that would mean that I would say a lot of people will start using companies to invest. Accountants are going to be loving that. More entities to charge billables on. But state revenues will be loving it as well. Oh, great. We're going to increase our revenue here because more land tax. And then I can't recall what the stamp duty rates are on companies and entities, but it just means it's really just going to change things. You might find more Australian expats using investment companies to invest in property as well. Remember, once you've paid that 30% rate of tax, you don't have to pay out the earnings out of a company. That's the great thing. And that's very different to a trust. A trust money has to flow through to its beneficiaries, whereas company can retain the profit and then just pay out dividends. And I guess the great thing about expats is they don't have to declare fully franked dividends in their individual tax returns. So it's like, oh, okay, I could use a company here to invest in property. I pay the profit tax, 30%, pay out the dividend, and it's not taxable on my individual level. But always seek tax advice.
Yeah.
I've given out too many freebies today. But but yes, there's ways they can do it, but it is scary. I do wonder how they'll change the concession within super. You made a good point before about SMSFs. A lot of expats Australians that are non-residents can't really run an SMSF, but for those that are in Australia that have an SMSF, right now your discount concession, you only get to discount 1/3 of the capital gain. So the tax rate is 15% within
Yep.
super. But if you hold that asset for more than 12 months, your tax rate, it drops down to 10%. It's just amazing that's a rate of tax, to be honest. So if they're going to change it from 50% to 25%, does that mean they're going to drop it further within super?
Yep.
Yeah, be interested to see what happens there and the flow-on impact and whether this snowballs. But I reckon the budget's going to be nasty. We'll have to wait and see.
Grim Jim. Is that what they call him? Grim Jim? Yeah.
I think so. But mate, that's probably a good point there to wind up today's episode. Keep an eye on the socials, guys. Plenty coming out, plenty of events on seminars, webinars. Keep an eye on the blogs as well. We're over in New York and San Francisco in a couple of weeks. So jump on the events page to register for those seminars, the masterclasses. But in the meantime, we'll have to wait and see what happens with rates and tax concessions in Australia over the coming months.
Looking forward to it. Thanks, James. Thanks, guys, for listening.
Thanks, guys. Catch you soon.